Hi, this is Brian with Leelyn Smith and your Q4 2022 update. Remember, at Leelyn Smith, we try to reach client goals with the least amount of risk possible. Okay, today's video is titled Why Markets Go Up Over Time, which is a very apropos video right now as we're heading towards what could be a recession or at least a strong slowing down of the economy. And this concept is so important that unfortunately is not covered in a lot of investment introductory investment courses, books, or even economics courses. And there are a couple main reasons why markets go up over time. One is from the bottom up or from the company level. The other is from the top down, the macro level. And then the third item I'm going to mention is the motive for all of this. And this is so fundamental and it's very overlooked today that it's worthwhile covering. But let's dive into the first two and then we'll end with the third. So the first one is the bottom up or the company level point of view. So corporate CEOs and management, they are there to ensure that the company generates profits. It's that simple from that level. Now, once those profits are generated, they have a choice of either reinvesting those profits, paying them out in dividends maybe, or even issuing buybacks. The point though is once we have profits, they have to use those profits to maximize the shareholders' investment. Otherwise, why would we as investors invest in these companies at all if they're not doing that? And then the third, the expectation for those profits are increased over time. And this is, in my world, this is called earnings growth. Earnings is just a fancy word for profits, but there is expectation that companies will continue to grow their profits over time. So not only are CEOs and management teams tasked with growing or with generating profits, they're also tasked with growing those profits if they can. At the very least, maximizing shareholder wealth. Now, from the top down or the macro point of view, there are three main components of growth. The first one is inflation. We have a lot of inflation right now, and that's why the Federal Reserve is raising interest rates so they can slow down that inflation. However, you do want some inflation. The Federal Reserve has a dual mandate, right? They have inflation at 2% annually, and then they have a 4% unemployment number, which we'll come back to in a minute. But inflation, you want some inflation. They're just trying to slow it down. A point being, if you have 2% average per year inflation, you have a generally growing economy, okay? The second point here is productivity. And this is, efficiency on a business level. Where as you get better at your business, you're increasing your productivity. Maybe that's through new software, whatever you're doing to increase your productivity. And that increase in productivity should mean, all things being equal, more profits. And then lastly, this is talked about a little bit in the media, is demographics or population growth. As our population grows, we have more people working. Now remember, this second part of that Federal Reserve dual mandate is a 4% unemployment number per year. And if our population is growing and we keep that 4% mandate, that means more people working. More people working means more people buying and generating activity in the economy. So those three from a macro point of view, two of which are Federal Reserve mandates, ensure that we have a growing economy. Now, the third piece to all of this, so those first two I covered were like the structural or the physical reasons why markets go up over time and economies grow. But this third one is really important to mention, and this is the motive for profit. So the motive for profit drives our prosperity because in order to profit, one must supply goods or services that raise the living standards of those purchasing those goods or services. Again, if they weren't, why would you buy any of this stuff, right? And because of free market competition, the standard of living is continually raised for all people involved. Now, who's behind this? Entrepreneurs. So entrepreneurs want to, number one, raise their living standards, and they therefore take on the risks inherent with entrepreneurship, which they should be compensated for. And then in order to profit, they must raise the living standards for their customers, which makes a continuous cycle of providing services, raise living standards, profit, okay? So now that we know why markets go up over time, these recessionary periods, or at least the slowing periods, are a little bit easier to weather. And the biggest risk to investing is our behavior. And if we're overreacting to recessionary periods, that's considered poor investor behavior. And if we can solve that, now we've solved the investing conundrum and we don't have to worry about it too much anymore. Hope you enjoyed this video. Keep a lookout for our next one. And remember, at Leelyn Smith, we try to reach client goals with the least amount of risk possible. Thanks for watching.